Let's understand the concept of transitional election in the context of UAE corporate tax law. When UAE corporate tax law, businesses may already have old assets or liabilities, and if later on these assets or liabilities are sold out or settled, part of the gain or loss relates to. To separate this fairly, law allows an elections to remove the pre-corporate tax portion from taxable income, only for specific qualifying items. And these qualifying items includes qualifying assets, qualifying liabilities, such as qualifying financial assets, qualifying financial liabilities, qualifying intellectual properties, and qualifying intangible assets. Let's try to understand each of them separately. Qualifying financial assets includes shares, equity investments, bonds, cook securities, and derivatives like future and options. Long-term receivable measures at amortized cost. Qualifying financial liabilities includes long-term loan, bond payables, and derivatives. Similarly, qualifying immovable properties includes land or building held before the first tax period. And qualifying intangible assets includes purchased trademark, patents, copyright, and brand. Remember, any intangible normally do not qualifying which are self-created. Why only these qualify? Because these assets or liabilities have measurable capital value, can generate significant gain or losses as disposal where required before financial corporate tax start. Let's understand the impact of transitional election at the corporate tax return. For example, we have a land. The purchase price of the purchase date of the land was 1st January 2019, and the purchase cost was 1 million. Corporate tax started in 1st January 2024 and disposal date 1st January 2027, whereas the selling price was 2.5 million. The gain arise on the sale of the land is 1.5 million. Let allocate gain on time basis. Total holding period is 8 years, from which 5 years relates to pre-corporate tax period and 3 years relates to post-corporate tax period. The formula is very simple. Gain multiplied by the pre-corporate tax period divided by the holding period, you will get 937,500 as a non-taxable income and 562,500 as a taxable income. Step 2, corporate tax effect. Although 937,500 is non-taxable, so there is no further action is required. Only 562,500 is a taxable amount on the basis of transitional elections has been elected by if the election is elected by the entity. Now entity only liable to pay corporate tax on the gain of 562,500 dirham, which comes 50,625. And due to the election of a transitional rules, the entities save 84,375,000 dirham. The general entry at the sale of the property will be debit the bank with 2.5 million, credit the land with 1 million, and credit the gain or recognize again by 1.5 million. Let's see the working for pre-corporate tax gain exclusive if election made. Not booked in accounts, only detected on corporate tax return. Corporate tax computation, capital gain on disposal 1.5 million, less pre-corporate tax excluded portion 937,500 and taxable gain rises 562,500 and on this gain, the 9% corporate tax is payable. So I hope you get the understanding on this topic. Thank you.